What if you could own a piece of America's biggest companies and get paid every 3 months just for holding the stock? No selling, no timing the market, no work. In this video, we break down the Dividend Snowball method, the slow, boring, unglamorous investing strategy that has quietly built real second incomes for ordinary investors for decades. Not flashy, not viral, not something you'll see a 22-year-old Lamborghini owner talking about on TikTok, but real and proven and available to you starting today with almost no money and almost no knowledge. Let's start with the basic mechanic, because a lot of people hear dividends and assume it's complicated. They assume it's something for finance professionals, for old men in suits, for people who understand things they don't. It isn't complicated. It's actually one of the simplest concepts in all of investing. And once you understand it, you'll wonder why nobody explained it to you 20 years ago. Some publicly traded companies, often large, stable, profitable businesses, choose to share a portion of their profits directly with shareholders. These are companies that make real products, sell real services, generate real revenue, and earn real profit. And instead of keeping all of that profit, instead of reinvesting every single dollar back into the business, they say, "We made money this quarter, here's your share," and they pay it out on a regular schedule, typically every quarter, 4 times a year, like clockwork, like a paycheck you never have to work for. If you own shares of that company, even one share, you receive that payment automatically. It's deposited into your brokerage account. You don't have to request it, you don't have to qualify for it, you don't have to sell anything, you don't have to time the market, you don't have to predict anything. You just have to own the stock. That's it. Ownership is the only requirement. You are a part owner of the business, and part owners get a share of the profit. That's the entire concept. That's the whole thing. Now, why do companies do this? Why would a massive corporation just hand you money for doing nothing? Because it attracts investors, because it signals financial strength, because a company that pays a consistent dividend is telling the market, we are profitable, we are stable, we generate more cash than we need to reinvest, and we are confident enough in our future to commit to paying you regularly. It's a signal of maturity, of stability, of financial discipline. Growth companies, startups, companies in hyper-expansion mode, they usually don't pay dividends. They reinvest everything. But mature, established, cash-generating businesses, the companies that have been around for 50, 70, 100 years, they pay dividends. And they've been paying them through every recession, every crash, every panic, every war for decades. Here's where the word snowball comes in. And this is the part that makes this strategy genuinely powerful over time. This is the part that turns a boring quarterly payment into a wealth-building machine. Most dividend-paying companies and most brokerage platforms offer something called a dividend reinvestment option, often abbreviated as DRIP. Instead of taking that cash payout, instead of letting it sit in your account or spending it, you can automatically use it to buy more shares of the same company. Fractional shares. Even if the dividend is only $12 and the stock costs $150 a share, the system buys you 0.08 shares, and those fractional shares start earning their own dividends next quarter. More shares means a bigger next dividend payment. A bigger dividend payment buys even more shares next time. Those new shares generate their own dividends, which buy even more shares, and so on, and so on, and so on. Quarter after quarter, year after year, decade after decade. That's the snowball. Dividends buying more shares, which generate more dividends, which buy even more shares. Compounding quietly in the background, whether the stock price is up, down, or sideways that particular quarter. You don't care what the market does today. You don't care what the news says. You don't care what the pundits predict. The snowball rolls regardless. The reinvestment happens automatically. The compounding doesn't stop. It doesn't take a day off. It doesn't get scared. It just accumulates. And here's what makes this psychologically powerful in a way that growth investing often isn't. You can see it happening. Every quarter, you get a statement. Your share count went up. Your dividend payment went up. You didn't add any new money. The system did it for you. You can watch the machine building itself. And that visibility, that tangibility, that quarterly proof that your money is working is what keeps people invested when the market drops 20% and every instinct says sell. You don't sell. You just watch the share count go up. And that's enough. Let's talk about the number that matters most in this entire strategy: dividend yield. That's simply the annual dividend payment divided by the current stock price expressed as a percentage. A stock trading at $100 a share, paying $4 a year in dividends, has a 4% yield. That means for every $100 you invest, you get $4 back per year in cash. A stock trading at $50 a share, paying $2 a year, also has a 4% yield. The price doesn't matter. The percentage is what tells you how much cash flow you're getting relative to your investment. Many well-established dividend-paying companies in the U.S. market have historically offered yields somewhere in the 2 to 5% range. Utility companies tend to be on the higher end. Consumer staples companies, the ones that make toothpaste and soap and food, tend to be in the middle. Technology companies that pay dividends tend to be on the lower end because they still reinvest heavily in growth. But all of them pay. All of them show up every quarter. All of them put cash in your pocket just for holding the stock. Now, here's a critical warning almost nobody gives new dividend investors. And this warning has saved people from losing thousands of dollars. An unusually high yield is often a red flag, not a bonus. If you see a stock yielding 8%, 9%, 12%, your instinct is to get excited. That's a huge return, free money. But here's what's usually actually happening. The dividend yield is calculated by dividing the dividend by the stock price. If the stock price has crashed, the yield suddenly spikes upward on paper, even if the dividend hasn't changed. A stock that was trading at $100 and paying $5 a year had a 5% yield. If that stock crashes to $50, the yield suddenly looks like 10%. But the business is in trouble. That's why the stock crashed. And a business in trouble is a business that's about to cut its dividend, maybe in half, maybe to zero. And when that happens, the stock price drops even further, and your high-yield investment becomes a permanent loss. This is called a value trap, and it destroys new dividend investors who chase the highest number they can find. This is why serious dividend investors look beyond the yield number itself and pay attention to the company's history of consistently paying and growing that dividend over many years, sometimes decades, as a sign of real underlying financial stability. A company that has raised its dividend for 30 consecutive years, through the dot-com crash, through the financial crisis, through the pandemic, is telling you something about its financial discipline that a 12% yield startup never could. Let's talk about dividend growth, because this is the part that separates a good dividend strategy from a mediocre one. This is the part that most people completely overlook, and it's the part that makes dividend investing genuinely superior to just holding a static bond or a savings account. Some companies don't just pay a dividend, they increase it every single year. Not sometimes, not when they feel like it, every year. For 20, 30, even 50-plus consecutive years, through recessions, through market crashes, through wars, through pandemics, through every economic disaster the modern world has produced, they raise the dividend every year without fail. Companies with this kind of long, consistent history are often referred to in the investing world as dividend aristocrats if they've raised their dividend for at least 25 consecutive years, or dividend kings if they've done it for 50 or more years. These are companies like Johnson & Johnson, Procter & Gamble, Coca-Cola, 3M, Colgate-Palmolive, companies you've heard of, companies whose products are in your house right now. Companies that have been paying and growing dividends since before your grandparents were born. owning a basket of these companies means your income isn't just compounding through reinvestment, it's also growing each year simply because the underlying payments themselves are increasing. You bought the stock yielding 3%. 5 years later, because the company raised the dividend every year, your effective yield on your original purchase price is now 4%. 10 years later, it's 5%. 15 years later, it's 6%. You didn't do anything. You didn't buy more, you didn't trade, you just held, and the income grew. That's the hidden superpower of dividend growth investing. Your paycheck from the market gets a raise every year, whether the stock price goes up or not. Let's run the actual math, because this is where the strategy goes from an interesting idea to a real wealth-building plan. This is where it stops being theoretical and starts being your actual life. Imagine investing $200 a month into a diversified basket of dividend-paying companies, or into a single dividend-focused index fund that holds hundreds of them. You set up automatic reinvestment. Every quarter, the dividends buy more shares. You don't touch it, you don't check it every day, you don't panic when the market drops. You just keep investing $200 a month, and you let the system work. Assuming a combined average return from stock price growth and dividend reinvestment historically around 7 to 8% annually, a reasonable long-term estimate based on broad market history spanning nearly a century, that $200 a month could realistically grow to roughly $100,000 over about 20 years. And continuing that same habit for 30 years could realistically approach $200,000 to $250,000, purely through consistent monthly investing and compounding. No luck, no stock picking, no timing, just $200 a month in time. $200, that's less than most people spend on restaurants in a month. That's a car payment on a vehicle that'll be worth nothing in 10 years. That's a streaming subscription bundle and a gym membership you don't use. $200 a month, redirected from consumption to ownership, becomes $250,000 over a working lifetime. And that $250,000 pays you forever. Here's the part that makes this genuinely exciting, the part that changes how you think about your entire financial life. Once that portfolio reaches a meaningful size, you can choose to stop reinvesting and instead start collecting the dividend payments as actual cash income. You flip the switch. Instead of the dividends buying more shares, they go into your checking account. They become spendable money, real money, money that arrives whether you worked that week or not. If a $200,000 dividend-focused portfolio is yielding around 3.5% annually, that's approximately $7,000 a year in dividend income, paid out in cash, without selling a single share of stock, without touching the principal, without reducing your portfolio. The shares are still there, they're still growing, they're still compounding, but the dividends are now yours to spend. $7,000 a year, almost $600 a month, arriving in quarterly or monthly payments, essentially functioning as a second paycheck that doesn't require you to trade your time for it, that doesn't require you to show up, that doesn't require you to perform, that just arrives. Let's make this even more real with a longer-term, higher contribution example. Someone who consistently invests $500 a month into dividend-focused index funds for 25 years, assuming a historical average total return around 8% annually, including reinvested dividends, could realistically build a portfolio approaching $400,000 to $450,000. At a modest dividend yield of 3% on that portfolio, that translates to roughly $12,000 to $13,000 a year in dividend income alone, over $1,000 a month, money that continues arriving whether that person is working, traveling, sick, retired, or doing absolutely nothing at all. And here's the part nobody talks about. That dividend income grows, Because the companies in the portfolio are raising their dividends every year, so that $12,000 a year becomes $13,000, then $14,000, then $15,000, without you adding a single dollar, without you doing a single thing. The income inflates with the economy because the underlying businesses are growing their profits and sharing that growth with you. Your second paycheck gets a raise every year, forever. Now, let's talk honestly about the risks and misconceptions, because this strategy gets oversold online constantly. There are YouTube videos and TikTok posts making it sound like you can quit your job in 3 years by buying dividend stocks. That's a lie, and it's a dangerous lie because it sets people up for disappointment and causes them to abandon a strategy that actually works, just not on the timeline they were promised. Dividend investing is not a get-rich-quick strategy. It is a get-paid-eventually strategy. It requires years, often decades, of consistent investing to produce meaningful income. The first 5 years, the dividends are small, almost embarrassingly small. You invest $10,000 and get $300 back in a year. It feels pointless. It feels like a waste of time. And this is where most people quit. They don't see the snowball yet. They just see a tiny pile of snow. But the snowball is forming. The compounding is happening. The share count is growing. And in year 15, year 20, year 25, the curve bends upward and the income becomes undeniable. But you have to survive the early years. You have to trust the math when the results aren't visible yet. Dividend payments are also not guaranteed. This is critical. A company can cut or suspend its dividend at any time. During the 2008 financial crisis, dozens of major companies slashed their dividends. Banks, automakers, retailers, companies that had paid dividends for decades suddenly stopped, and shareholders who were relying on that income got nothing. This is exactly why diversification across many companies, rather than concentrating in just 1 or 2 high-yield stocks, matters so much for managing this risk. If you own a dividend fund that holds 300 or 500 companies, one company cutting its dividend barely affects your total income. If you own 2 stocks and one cuts, you've lost half your income. Diversification isn't optional in dividend investing, it's survival. And dividend income is generally taxable. In a standard brokerage account, qualified dividends are taxed at a lower rate than ordinary income, typically 15 or 20% federally, depending on your bracket. But you still owe taxes on them every year, even if you reinvest them. In a Roth IRA, dividends grow completely tax-free, and you never owe a dollar on them. In a traditional IRA or 401k, they're tax-deferred, meaning you don't pay until you withdraw in retirement. The type of account you hold your dividend investments in dramatically affects how much you actually keep, and this is something you should think about before you start, not after. There's also a common mistake called yield chasing, and I mentioned it briefly before, but it deserves more attention because it's the #1 way new dividend investors lose money. New investors sometimes get excited by unusually high dividend yields. They see a stock yielding 9%, 10%, 12%, and they think they've found a hack, a shortcut, a way to get rich faster. But abnormally high yields are frequently a warning sign of a company in financial distress. The market is pricing in a dividend cut. The stock has crashed because the business is failing, and the high yield is just a mathematical artifact of a collapsing share price. The most reliable dividend investors historically have favored companies with long, consistent histories of paying and growing their dividend, even if the current yield looks modest compared to riskier, higher yield alternatives. 3% from a company that's raised its dividend for 40 years is worth infinitely more than 10% from a company that might eliminate it next quarter. Let's also talk about the psychology of why dividend investing works for people who struggle with other forms of investing. And this is underrated. This is genuinely important. Growth investing, buying stocks and hoping they go up in price, requires you to do nothing for years while watching the number bounce around.
Some days you're up 20%, some days you're down 15%. There's no income, there's no cash flow, there's just a number on a screen going up and down. And for many people, that's psychologically unbearable. They panic, they sell at the bottom, they abandon the plan. Dividend investing gives you something tangible, something visible, something that arrives in your account every quarter regardless of what the stock price does. The market crashes 30%, your dividend still arrived. The news is terrifying, your dividend still arrived. Everything is on fire, your dividend still arrived. And that consistency, that regularity, that proof that the machine is working is what keeps people invested when every emotion says quit. It anchors you, it gives you a reason to hold, it gives you a reason to keep buying. And that psychological anchor is worth more than any mathematical optimization, because the best strategy in the world is worthless if you can't stick with it.
Here's the framework to take with you. 5 rules. These are the principles that separate successful dividend investors from everyone else. Write them down. Make them your filter. Make them your commitment. Rule 1. Focus on consistency and reinvestment in the early years. The snowball effect is what does the heavy lifting over time, not any single large investment. You don't need a lump sum. You don't need to wait until you have $10,000. You need $200 a month and the discipline to not stop. The early years feel slow. They feel pointless. They feel like nothing is happening. But the snowball is forming. Trust the process. Keep reinvesting. Keep buying. Let the compounding do its invisible work. Rule 2. Prioritize companies with long histories of consistent dividend payments and growth over companies simply offering the highest current yield. 25 years of consecutive dividend increases tells you more about a company's financial health than any yield number ever could. The aristocrats and the kings are your foundation. The high-yield unknowns are your risk. Build on the foundation. Rule 3. Diversify across many dividend-paying companies or a diversified dividend-focused fund rather than betting heavily on just 1 or 2 stocks. One company can fail, one sector can collapse, one recession can wipe out an industry. But 300 companies across 10 sectors, all paying and growing dividends? That's resilient. That's durable. That's a portfolio that survives anything. Rule 4. Understand that this is a long-term strategy. Meaningful income typically takes 15 to 25 years of consistent investing to fully materialize. Anyone telling you otherwise is selling you something. The math is the math. Compounding takes time. The first decade is slow. The second decade is faster. The third decade is where the curve goes vertical. You have to be in it for the third decade. That's the commitment. That's the price of admission. And Rule 5, decide in advance when you'll shift from reinvesting dividends to actually collecting them as income. That transition point is when this strategy starts functioning as a second paycheck, and having a plan for that transition, a target portfolio size, a target income number, a target date is what keeps you motivated during the long, slow middle years. You're not just accumulating forever, you're building towards something. You're building toward the day you flip the switch and the money starts arriving as spendable income. Know what that day looks like, know what number triggers it, and build toward it with intention. This is exactly why dividend investing has quietly built real financial independence for so many ordinary people who never had a flashy business idea or a lucky stock pick. Teachers, nurses, engineers, factory workers, administrative assistants, people who never made more than $70,000 or $80,000 a year, people who never went viral, people who never started a company, just consistent, boring, repeated investing. $200 a month, $500 a month, every month, for 20 years, for 30 years, and enough patience to let the snowball roll. And now, they collect a second paycheck every quarter. And they didn't have to be smart, they didn't have to be lucky, They just had to be consistent, and they had to not quit. So here's my question for you, and I want you to really think about this before you answer. Comment below and tell me, would you rather have a bigger paycheck today or a smaller paycheck now that quietly grows into a second income stream over the next 20 years? Would you rather spend the extra $500 a month on a lifestyle you'll forget in 6 months, or invest it into a machine that pays you for the rest of your life? There's no wrong answer, but there is a consequential one. And the choice you make today, this month, this year, determines which version of your future you get. Subscribe to the Violet Vault. Hit the notification bell, because next time, we're breaking down another investing strategy that turns consistency into real, lasting wealth. We don't do hype here. We don't do get rich quick. We do the slow, proven, unglamorous work that actually builds freedom. And if that's what you're here for, you're in the right place. Because remember, dividends were never about getting rich overnight. They were never about a lucky pick or a viral moment or a perfect entry point. They were always about getting paid quietly again and again for decisions you already made years ago. The money arrives because you decided a long time ago to own instead of consume, to build instead of spend, to be patient instead of impulsive. And that decision, made once, pays you forever. Thanks for watching the Violet Vault. I'll see you in the next one.